Hello, everyone. My name is Abero Clay, and we are going to be going through some year-end tax planning strategies. I wanted to get everybody in quickly this year because there's just too many things going on. And I felt it would be good that we all connect now. We are going to try to do another call in December, but I wanted to get in early now because it's very important that we start to address some things for this year. Hi, Wayne. Let's see who else. I think I got everybody. All right, and I have some accountants on the line today that are part of my team. I have Jean is here. I have LaShawn. I have Israel. I have Aleemah. I have Moses. Okay, so we have a good base today. Hi, Nakia. Hi, Joy. Hi, Antoine. Hi, Bridget. Hi, Cynthia. Okay. So I'm going to go really quickly. I really want this to be more conversational than it is me teaching. And there's some work that I haven't done yet, like looking at all the new tax laws or whatever. There's nothing that's out of the ordinary, but I need to pull it together. We'll have that before our next meeting. But the main reason why I wanted to bring in everybody here is too much is going on. Inflation and, real estate, that's our industry. We're starting to feel the impact. Job losses coming down the pike, property sales, people's property staying on the market longer. So I just wanted us to start talking to figure out what we're gonna do for year end. And forgive me, I'm recovering from a cold, so you might hear my sniffles every now and then. Most of you already know me. I don't know anybody on here. Most people here are in the wealth building program are already a client, so I don't need to go through all that. Family as usual, everybody is doing well. Oh, by the way, my daughter bought her first rental property and the tenant moved in on Sunday. So we now have another landlord in the family. So that's exciting. So year-end tax planning. April 15th is the tax filing deadline. December 31st is your tax savings deadline. So anything that you're not doing between now and December 31st is just going to be a whole lot of stuff that you're dealing with during tax time. So if you really want to save on taxes, this is the time to start taking a look at everything that has happened. And you don't necessarily have to do a detailed one. For most of our clients in the wealth building program, we do ask them to send in documents to do that analysis. Well, you can do a quick back of the envelope analysis. Like, did you have any significant events? Did you sell any property? Did your business make more last year than it did, this year than it did last year? Did you get married? Did you get divorced? Do you have children that are dependent on you last year and no longer dependent on you this year? All of that impacts whether or not you need to consider doing the full year-end tax planning. But remember, whatever we don't put in place by December 31st, it's going to be too late. Okay. So we're going to go through, these are the normal ones. You'll see a lot of 2021s here. Like I said, I can afford to let you guys know that I have not made the updates yet. I'll be making them next week and adding some additional stuff. But this is pretty much the stuff from last year you want to be aware of, right? If you own your business, you have an EIN number, operating agreement, separate bank account. Have you recorded all of your income and expenses related to the business on the business bank account? Aleemah is going to be talking about bookkeeping shortly. If you own investment property that was foreclosed or a short sale, have you considered the impact of cancellation of debt income? If you generated active real estate income, have you considered restructuring? If you have significant real estate education expenses, have you considered minimizing your audit exposure? If you have business expenses and already have a registered business, do you need to convert to a multi-member LLC? Have you considered the impact of wasted deductions? Do you know what the requirements are for your state? Have you considered cost segregation study? If you bought or sold property, have you considered the impact of capital gains? Okay, so that's the first list that we go through. So I'm going to take some of the questions that you guys have now, and then I'll turn it over to Aleemah to kind of go through some things. I'm not seeing Tyrone here. Tyrone, if you're here, please indicate on the chat that you have joined. So let me look at some of these questions here. All right, so LaShawn was asking any new tax laws that may affect year-end tax planning. The last time I checked, it wasn't anything huge. You know, the recent one that just passed, when we looked, there's not a huge impact. So there's nothing like, you know, last year where we had a lot of changes going along. There's nothing out of the ordinary for this year where we need to be concerned and take into consideration. I am still putting a list together, but there's nothing that is major. Okay, somebody will receive an inheritance. So in terms of what we do with an inheritance from a deceased relative, you know, by the way, accept my sympathy. It depends on the kind of relationship. If this is between a direct lineal descendant, then you get the property or asset at fair market value. So let's say, you know, this is a parent that passed, or this is a child that passed, and they have a real estate property, you get this property at fair market value on the date of their death. So if they passed in March, it would be the fair market value on the day that they passed, not what they purchased it for. And then if you sold it, then you do the capital gains based on what you purchased, based on the fair market value on the date of their death. So if that has not already been done, you want to go ahead and get an appraisal or determination of what that fair market value is. I just did a consultation with somebody today, you know, where their mom passed, and it's, you know, the appraisal then was $315, but then they sold it for $258. So it's going to be a loss and will be reported on the estate return. If it's not a direct lineal descendant, then you have to do based off of the basis of the property. So if they bought the property for $200,000 and put about $20,000 to fix it up, and then they pass, well, your basis is going to be $220 less the sales price. So unfortunately, you are going to have capital gains tax that you're going to pay on the property if the person is not your direct lineal relative. Okay. Can you write off special assessment fees from a condo rental? Yes, if the condo rental is a rental. Yes, so if the condo is a rental property, then yes, the special assessment fees is almost like the condo fees. I know those are ridiculous, right? Sometimes they're really high as the condo fees themselves. But yes, you are able to get, you're able to write those off. All right. Home sale, how that affects your taxes? It depends on what. Alma, can you give me some more detail? Is this a rental property that was sold or your primary? If it's a primary, you're able to exclude the first $250,000 if you're single, $500,000 if you're married. So we'll need to do a calculation on what the capital gains is and then see if it's over that $250,000 limit.
It's just a clarification, it's the rental property.
Oh, rental. Okay, so if
Yes.
a rental property was sold, then you definitely want to actually do that calculation now. You would send us the document so we can calculate it, because guess what? For a rental property, you have to recapture the depreciation that you've claimed over the years. So whatever depreciation that you have claimed over the years, you would need to recapture. So a lot of people think, oh, because I sold the property for 200,000 and then I had a, you know, they paid off the loan, I only got 50,000, that's what I'm going to pay taxes on. No, that's not what you're going to pay taxes on. You're going to pay taxes on the depreciation that you've claimed over the years. And then the way to calculate the capital gain is the sales price less the selling expenses. That's the net sales price. And then your purchase price, any improvements, less the depreciation that you've claimed over the years. A lot of people don't take this into account when they're calculating the capital gain. So if a property was sold and you are our client, which most of you here are, please send in your settlement sheet. Send me your worksheet of how much you incurred to get the property ready for sale so we can calculate those capital gains right now. Okay? If you did not do a 1031 and you did not invest in an opportunity zone, then yes, you definitely are going to have, you know, taxes that you're going to pay. So somebody else said, avoid owing the IRS. Well, Razak, I don't know if I can help you with that. But I do know that we can help you reduce the amount of taxes that you have to pay, which it depends on the kind of income and what kind of income you earn. The kind of tax exposure you have is based on what kind of income you earn, whether you're earning active income like a W-2 job or a business income, or whether or not this is passive income. Is it a net rental income? Is it capital gains? You know, is it interest income? That determines the kind of taxes that you have. But at the end of the day, if you have active income, you may not be able to get out of owing the IRS, but there's some strategies that you can implement, like setting up a retirement plan. You can invest in like oil and gas. You can set up charitable contributions. You can invest in solar panels. All of this require cash outflow, even though it gives you a tax benefit. So you need to look at how much cash you have available at your disposal, and if you have time to, if you have the money to invest in like a retirement account or in an investment vehicle such as oil and gas and solar panel to be able to get that deduction. What do you consider the most negative law that impacts small businesses this year? I usually don't think in those terms. I always feel that opportunity meets a prepared mind, that no matter how much they change the law, as business owners, we need to figure out alternatives to circumvent or go around that law to still keep making money. You know, so there's so many, that's what I said, there's just a lot that has happened this year, but we just have to find ways around it. Okay. Any new credits available? No new credits is the same ones that we typically have. What's the eligibility criteria to avoid capital gains tax? It's you have to be at a 0% taxable, zero tax rate taxable income to avoid capital gains, right? So if your tax rate is at 0%, which comes out to about $37,500 of taxable income, then you're not going to pay any taxes on your capital gains. And then if you're married, if you're under taxable income of $73,000, but other than that, you'll have to pay capital gains. Can I deduct contributions made to a rollover IRA from a previous employer? And if no, if it's a rollover, maybe I'm not understanding the question, Tracy. If it's a rollover IRA, meaning that you rolled it over into another plan, it's not a contribution, it's a rollover. So I guess you're talking about that you did make new contributions before you rolled it over. How much should we set aside for taxes for an LLC that is a pass-through entity? Catherine, it depends on how much income the business generated, right? And then it also depends on what you have at your regular job. Let's say at your regular job, you make over $150,000, but then your business, you made maybe about $30,000. Well, because you're over the Social Security income limit of the 140,000, then that means you're not going to be paying the additional payroll taxes. You're only going to have Medicare tax. But let's say your income, your regular wages is 100,000 and you generated another $50,000 at your business. Well, $50,000 off the top, you're going to pay $7,500 in payroll taxes before we even talk about the regular federal and state taxes. So it's not a question that we can answer easily because it takes into account the income that you have from other sources, which is why we suggest, ensuring that you get the year-end tax planning done. Okay, Tamimba wants me to highlight number 5 on the list. If you have significant real estate education expenses, have you registered a business in order to minimize your audit exposure? So number 1, any expense that you incur to improve your learning or knowledge is not deductible. That's the rule. However, if you have an LLC and the LLC requires you to get those education expenses and they're reimbursable to you in order for you to be a perfect manager for the business, then you are able to get that deduction. So it's understanding the difference. By itself, improvement courses or courses that you take to improve your skill and knowledge, you're not able to deduct. But if you have a registered business and the operating agreement states that you are required to take these courses in order to be an effective managing partner and is reimbursable, then you're able to get that expense. So having a registered business, if your expenses are high, would be the way to go. Is the interest on a home equity loan that was used? Yes. If you're able to trace the expenses for the home equity loan directly to a business or rental property, you are able to deduct it. Camille asked a very, very important question. I want everybody to listen to this. I'm going to increase my volume because this is very important. Is it wise to depreciate property? You do not have a choice. Please write this down. You don't have a choice on whether or not you're going to depreciate your property. Because guess what? When your property sells, or if you get audited, it's going to be based on depreciation allowable, not depreciation deducted. Okay, this is very important. A lot of people say, well, I don't want to depreciate my home office, so I'm not going to take depreciation on the rental because I don't want to deal with depreciation recapture. You're dealing with a double whammy because guess what? You don't claim the depreciation, but when the IRS recalculates your return, they are calculating it based on the depreciation that was allowable, whether or not you deducted it. So you have to take the depreciation, whether or not you want to, because you're going to be shortchanged at the end. And if you look at the tax law the way it's written, it asks you to recapture the depreciation allowable. It doesn't matter whether or not you took the deduction. Okay. Does a holding LLC need EIN and be required to do a tax return if it would only be holding property in the LLC and not doing any transactions? Very good question. I do think it needs an EIN, but I don't think it needs to file. It can be a single member LLC, and a single member LLC, if you don't have any activity, then you do not need to file. But I do think it needs to have its own separate identity, especially if it's going to be a holding company. Okay. I'm transferring a property under my LLC to myself. The refi lender requires me to dissolve the LLC. Yeah, that's something that I usually, tell people before you transfer a property into an LLC, you need to make sure you're done with everything financing. Because if you're not done with anything financing, it defeats the whole purpose. You're having to pay transfer taxes in and out. But anyway, so going on with Talanka's question, any tax impact on dissolving the LLC? There's no impact, but the bottom line is that if it's a primary residence, it's a primary residence, whether or not it's in an LLC. If whether or not it's in an LLC, it's the it's a primary residence. So the attributes of a primary residence will apply whether or not you have it in an LLC. Okay. Can we roll over deductions not taken to the following year if not needed? Yes, that's what we were talking about, wasted deductions and amortizing. You can amortize your expenses so that in such a way that if you do not use it in 1 year, you're able to use it in another year. Okay, so I'm going to turn this over now to Aleemah. She's just going to share with you guys a few tips. Let me see if I can pull up the sample schedule. We prepared a sample schedule of deductions that you're able to claim. Let me share that with you as she gets ready to, okay, Aleemah, I'm gonna have it up and then you can talk from it or just talk generally. I just want them to see. And if you want us to send you this list, please email us and then I'll share with you. Aleemah, you can go ahead.
Okay, all right, so last year we did a webinar just trying to ensure that when you're coding your transactions, and if you are running a business, you should be coding your transactions at least I would say twice a year. Not everyone doesn't have if you don't have a lot of transactions, monthly is sometimes not a requirement for you, but to keep track of what you're doing in your business and to make sure that once you get to the end of the year, you're ready to have your taxes filed. These are the accounts that we use, and we just pulled this off of the tax return. So it's nothing that we didn't come up with anything. We pulled these directly from the tax return. So these are the categories that everything should fall in. When you're, so like I said, your accounting, of course, is accounting, but I know sometimes there are things when people have questions on whether or not, what they could possibly fall under. And my suggestion is, don't go too deep into it. Sometimes you have something, I'm trying to think of an example, like a coaching program. Of course, we'll be training. You can also put it under, if you pay it monthly, you can put it under dues and subscriptions. As long as it has a code that relates to one of the deductions on the tax return, then you're okay. If you're using QuickBooks and you have multiple businesses or multiple types of businesses that you're running, I would say ensure that you are using the QuickBooks Online Plus, because that allows you to code things by classes. And a class would be if I had, let's say I had a property management business where I was managing property, and then I also had a flipping business. So what I would do is I would code all of my property management transactions to that property management business class, and then I would code my flipping transactions to that flipping business class. And then that way, at the end of the year, once we're working on your tax returns, you're able to pull a specific report specifically for each business, because they're because of the way we enter them in the return, everything can't be all entered on that same screen. So you want to be able to have that separation. Another thing is limiting the amount of personal transactions that you're running through your business. The IRS, they don't require you to have a separate account, but they can require you to keep your transactions separate, which is rather confusing. But their thing is, if you're using your business bank account for personal transactions, and then we pick up one of those personal transactions on your return, how can they ensure that that transaction was actually a business transaction in the end? And so what may happen is that transaction may get added back because you can't 100% prove that this was not personal. And a lot of people do it. Like I said, it's just like the biggest thing is the easiest way is just to keep a separate account. That's the easiest way to keep your transactions separate. And then when you're out and about, like I said, ensuring that you're using the correct card. We all have mistakes. I make my own mistakes, but just to ensure that you're using the correct card when you're out, to make sure that the deductions correctly get picked up. And then again, even like on the income side, you want to make sure that if you're being paid through your business, you want to make sure that the business income is going into an account where you can track the income, so you're not missing out on income. So if you're using your QuickBooks, and let's say you don't get any sort of tax document at the end of the year, you want to make sure that all the income that you thought you had and that could possibly be reported to the IRS, that you've picked up. And if you have it going to multiple accounts, and if you have people giving you cash and writing you checks, and you're not coding them all in the, they're not depositing them all in that same account, then again, it's gonna, your income is going to be understated, which could again affect your bottom line, and nobody wants their bottom line, affected. Especially if you have income over here and then you have expenses over here, you want to make sure you capture everything that you've done for that business. That's pretty much it. Does anybody have any questions? Kind of general questions? I heard somebody say something. So a personal credit card, if you use a personal credit card and you only use it for business, that's not an issue. But if you have a personal card that you're using it for personal and business, I would not do that. I would either get a business card and use that business card for your business transactions, or stop using that personal card for personal transactions.
I agree. Definitely, you want to commingling would not make it through an IRS audit with commingling. If you're good, and also think about it, if you're really running a business, you do want things to be separated. Right. How are you going to know how your business is doing if everything is commingled and everything is under your personal name? So even if you have a personal credit card, that for personal reasons, you're using for the business, let it be dedicated to just business. Make sure you have your separate bank account. Make sure that, we've had problems where somebody would send us a profit and loss statement and it's not coded by class. So we don't know what's rental. We don't know what's rehab. We don't know what's general. And it ends up slowing down the tax preparation process. And now we got to send you back to Aleemah during tax season to get your books cleaned. So you do want to start looking at your bookkeeping now. Even if you're preparing your bookkeeping yourself, you can engage Aleemah, 1 hour, 2 hours to do a review of what you have. A lot of people leave a lot of money on the table because you did not do your bookkeeping properly. What I tell people is you can either pay me or pay Uncle Sam. Either way, you're going to be paying somebody some money, so make sure that you are using your money wisely to get the deductions that you deserve. Okay.
LaShawn asks, do you feel most business owners can handle this themselves, or at what point do you recommend outsourcing? I would say it depends on the person. I have a client who is a therapist, single member LLC, and she knows that numbers are not her thing. And she, every time I talk to her, she's like, I'm just so grateful that I have you as my bookkeeper. She said, there's no way I will be able to keep up with this. And she has really minimal transactions each month. But she knows, because she's not good with numbers, she doesn't like, looking at numbers. She knows that this is not her thing, and leaving it up to herself to complete, it would never get done. So it just depends on the person. And probably the type of business. If you have something where you're running, a couple, $40,000, $50,000, $60,000 worth of income and expenses through an account, are you able to keep up with that and still grow your business? If you can, then I would say keep going at it. But if you can't, then you probably need to look at outsourcing.
Just a little plug. Yeah, I'm going to answer some more questions, and then I'm going to bring on Tyrone Taylor, who would be talking to us about the tax resolution side. You want to calculate how much you make per hour, right? Because as a business owner, you need to move to where you're getting paid per thought, not per action, right? Getting paid per thought, working on your business, not in your business. So even though you may be saving all this money, doing your own bookkeeping, doing your own taxes, being your own administrative assistant, is that the greatest and best use of your time? If you were to hire somebody and paid somebody to do that, does that free you to think to be able to grow your business, right? Remember, we're talking, this is the wealth building circle. We're talking about wealth building, not just tax savings, right? So you want to calculate how much do you get paid per hour. If you don't know what it is, just take whatever your regular salary is and divide it by 2,000 hours. That tells you how much you're making per hour. Are you able to pay somebody less than that to handle whether it's the bookkeeping or the administrative assistant, the marketing, to free your mind to focus on what really helps you to grow your business, right? So I want you to think in those terms when we're talking about, you know, whether or not you should hire somebody else or whether you should do it yourself. I'm able to do bookkeeping myself, but Aleemah will tell you a Ebere should not be touching nobody's bookkeeping, right? Because there's just some things that, I mean, I can do it, but it's not the greatest and best use of my strength. So I let her handle it, you know, and she works with somebody else to get it done, but I can't do my own bookkeeping. I can do payroll. I know how to do the calculations. I'll probably do it better than 80 people. Why am I going to do that? It's not the greatest and best use of my time because I get paid per thought. All right. If my spouse is a member of an LLC, can we take a trip somewhere once a year and call it board meeting? Okay, Talanka, you really pushing it now. So the answer is, are you able to combine business and personal travel? Yes, but you can only deduct the portion that relates to the business. If you're out there for 5 days, did you have one day where it was strictly business? Now, I know that some people teach where you can use a strategy where you want to convert personal expenses into deductible business expenses, but it needs to be ordinary and necessary for your business in order for you to claim that deduction. So my answer is always, it depends. You know, when you say you're calling it a team bonding meeting, what kind of business happened while you were on the trip? And then is it ordinary and necessary? Okay. Are there tax benefits to putting your primary residence in an LLC then rent from the, no. If it's your primary residence, it's your primary residence. It's one out in one hand in the other. If you rent to your LLC $1,500, well, your LLC has $1,500 income that's going to come back to you, and then you have $1,500 expense. So it's the same thing. I know that a lot of times, especially in the real estate circle, we hear a lot of things in front of the room, but it actually is not helping you. You're wasting a lot of time going in and out of LLCs and trying to structure this and structure that. At the end of the day, the goal of every business is to make money. And sometimes we get into analysis paralysis, trying to figure out different ways of getting things done, but it's not actually helping you grow your business. Okay, what's the best way to determine your maximum deductions to qualify for a business bank loan? I don't know that you can answer the question in that way. I think that in order to qualify for a bank loan, they usually would look at your debt to income ratio and your income. So I usually tell people it's an inverse relationship. You can't say that you don't want to pay any taxes and at the same time you want to qualify for a loan. It cannot be both. But in terms of maximizing your deductions, you might be able to amortize some deductions just so that you have more income. But you can't say the best way to determine your maximum deductions because it's a lot of factors. You know, it's your credit score, your DTI, your debt to income ratio, what it is you're trying to, and then also the bank. Each bank has their own underwriting requirements. I have a client that would go to this bank and whatever deductions they're able to get, whatever they're able to qualify for in this bank, they're not able to qualify in another bank. All the financials, everything is the same. So this is something that you really should be talking with your lender to know what their requirements are. Sometimes we move funds between LLCs. Is this okay? As long as you record it as an intercompany transfer, I don't see that as a problem. Okay. What platform is best to work remotely in QuickBooks? Desktop? What platform is best to work remotely in QuickBooks? I think it's the online, Aleemah, right?
No, she's saying It's called, I think it's Go to My PC. They might have changed the name, but it used to be Go to My PC. And that way you can remotely
Oh,
log in.
somebody else that do remote login. Oh,
Right.
okay, I see what you're saying. Actually, let me tell you a secret. Did you guys know that you can take over control of somebody's screen on Zoom? If you're in Zoom, you can take over somebody's screen and control the prompts and do whatever. It even helps the person to see what you're doing. So that's just a shameless plug. Okay. Are we able to write off a car lease? Are we able to write off a car lease? Yes, you're able to write off a car lease, but it has to be percentage of business use. I get this question a lot. If I buy a car in my business name, am I able to write it? It doesn't matter whether you have it in your name or the business name. It's only what is related to the business based on percentage of business use. So if you have a car in your business name, but you only use it 10% for the business, well, the other 90% is not deductible. And if you have a car in your personal name and you use it 20% of the time for the business, you are able to get a 20% deduction on the car. Mortgage interest on an investment property, yes, you can deduct mortgage interest, taxes, insurance, repairs, depreciation on a rental property. Okay. Should rental property be in your name or trust or LLC? It depends on your financing needs. This is something that I go through with a lot of people all the time. I think Talanka just demonstrated for us what I've often explained. If you're going to refinance at some point or deal with any kind of lender at some point, they will require you to have that property in your name, especially if it's a residential property. So it doesn't make sense to move a property into a trust or LLC if you're still dealing with financing. If you're done with financing and depending on the county where the property is located and all the transfer taxes, recordation taxes, then you may not necessarily need, you are able to transfer it without having to deal with all the taxes. But in terms of asset protection, if you're not able to move it into an LLC, or because moving into an LLC is cost prohibitive, the transfer taxes and all that, just make sure you have a really good umbrella policy and that you have a separate LLC that's acting as a property management company. Okay. What are your thoughts on paying our children that work for us as an employee or contractor? If they are doing reasonable work, the salary or whatever you pay them needs to be reasonable. If they are under 18, you can have them on payroll and not have to do payroll taxes and contribute to a Roth IRA for them. But it needs to be reasonable. Like, you can't have a child, helping you with supplies and you're paying them $50 an hour. It's got to be reasonable. And they really have to be doing work for the company. So the answer is yes, but you need to be aware of the guidelines. For intercompany transfers, should we also move back the bank fee? Aleemah, do you understand this question?
I don't understand. You mean like if it's a wire? If
Yes,
it's a wire, then it's just a fee that you pay to move the transfer. I would code the fee as the fee because usually it comes in as two separate transactions. So I would code the fee as a fee, and then the transfer would be coded as a transfer, intercompany transfer.
Okay, I had a high vehicle repair 2022. Can I use that versus mileage? Unfortunately, you cannot go back and forth between mileage and actual deduction. You have to decide which one you're going to do and stick with it. So if you've been claiming mileage, you can't say, oh, because my repairs are high, then now I want to switch to actual, even though it's also based on percentage of business use. So just because you had a high repair, depending on the percentage of business use, it may not be the same amount as what you would get with the mileage. Also, can the transfer be between businesses in different industries? Yes, absolutely. You can do a transfer between, but just make sure that you are coding it properly. All right, I don't know, Craig, if you had a question. If you had, you can unmute yourself, but I went ahead and muted you again. Okay, so we are going to welcome Tyrone. Tyrone is one of our industry partners. I wanted him to come on. We're looking at working together this coming year, just to talk to us a little bit about tax resolution, answer any questions you guys may have about tax resolution. He's going to give us some tips for those that are dealing with tax resolution issues. Tyrone, go ahead.
Yes, good afternoon, everyone. Again, my name is Tyrone Taylor. I am an enrolled agent based out of Nashville, Tennessee area. If you're not familiar with enrolled agents, our specialty is actually representing taxpayers in front of the IRS. So we primarily work with individuals who are dealing with audits, who have tax problems, haven't filed in a long time, maybe have large balances that they're looking to settle. So I'm joining the team, and if you ever have any questions about taxes in general or how to deal with the IRS or state issues, because I find that especially state issues, I find that a lot of small business owners, they have a time dealing with states, and I've dealt with quite a few states across the country. I'll be happy to answer any questions for you in regards to that. The advice that I give to taxpayers, especially small business people, is I come from the perspective of avoiding audits, or if you're going to be in an audit, how to make sure that the information that you're providing or the information that you have is going to support your audit. I'm not afraid of audits. None of us should be, because if we're keeping the correct records, if you listen to us as tax professionals, if you're keeping your records like you're supposed to, then being in an audit shouldn't be an issue. And I believe audits will increase. They won't necessarily increase as much as everybody thinks they are. It's just that for the last 15, 20 years, IRS has been understaffed, and they've got a large sum of money. So recently, I'm sure everybody's heard about the 87,000 new agents the IRS is going to be picking up, which that's not true. 87,000 new employees. But some of those employees will be auditors. They'll be new. There's a lot of new auditors coming on board. And so it's important to have someone on your side that can basically support you if you're being audited or if you've got a tax issue. So if anybody has any questions or concerns or anything, an issue that they're dealing with, I've been in the tax industry for about 16 years, so there's not a whole lot that I haven't seen. I don't know everything. It's almost impossible for a tax professional to know everything about taxes, but I know quite a bit. And so I'm always happy to give advice or answer any questions, not just about tax representation, but just taxes in general. The advice I tend to give to people is conservative, because again, I focus on making sure if you're dealing with an audit, or if the issue pops up, like some of the questions that have popped up, I'm like, no, don't do that. Because if you're being audited, you don't want to not be able to support the position you're taking as far as whatever you're deducting, or how you're dealing with an asset or a liability or income or expense that you're declaring, and not being able to deduct it. So that's pretty much it. Does anybody have any issues that they or question? I see this one question. Someone's not filed a tax return in over 15 years, afraid of owing. Where would they start? Okay, so if you know someone who has not filed tax returns in a long time, I have some good news. One is, it doesn't matter how many years they haven't filed. To be in what's called tax filing compliance, the IRS requires that you file just the last 6 years. Okay, so that's a good thing. So I mean, I run into people that haven't ever filed, or haven't filed in 20 years, but as long as they file tax returns in the last 6 years, that brings them in the IRS considers tax filing compliance. If the IRS wants more, you let them ask for more. But when I'm working with a client, 6 years, that's it. And generally, it's almost not impossible, but they generally don't ask beyond that, because they have to get a specific approval from a manager as to why they're asking for more than 6 years of tax returns. And so first thing you're going to do is file those tax returns. Second thing, if they're self-employed, they immediately need to start filing, paying estimated tax payments if they haven't been paying taxes for that particular year. Okay, so for example, if you know somebody right now, they're self-employed, they haven't been paying taxes. First thing they do, start sending money into the IRS, because there's no point in filing all these taxes, bring yourself into compliance if the next year you file your returns and you got new balances. So is it true that MMLCs are audited less than single? Audits are not really based on the structure of the business. Audits primarily are given based upon different criteria. The main one, from my experience, is when a tax return is turned in and there's different things about the tax return that are out of scope. For example, the IRS will look at how a tax return is compared to other returns within that specific industry. So for example, if you're a real estate agent and say maybe, you know, you're declaring I've got mileage and I drive 10,000 miles per year, and that's what I'm writing off based upon that, that's probably normal. But if you're saying I'm a real estate agent and I drove 40,000 miles in 1 year, well, the IRS might take a look at that. So there's that's the one criteria. The other one is just random. Sometimes they have these audits are based on national, I can't remember the exact term, but they're nationally based and they'll audit everything. Those are the worst audits. I haven't dealt with those luckily, but that's where they look at every single deduction. Generally, audits are concentrated into specific things that the IRS is looking for. But those national audits, which are rare, that's where they look at every single thing that is a part of that tax return. So hopefully none of you ever have to deal with that.
Just to comment before we move on to the questions, we have typically seen less audits with partnerships than with single member, but simply for the fact that partnerships are a little bit more complicated. And the people who are usually claiming outrageous deductions are usually doing them on the Schedule C and Schedule E. So the Schedule Cs, which is where you file the single member LLCs, tend to be audited a lot more than the 1065s, and the Schedule Es are audited a lot more than the 8825s. I think I've only had one partnership audit all my years of doing taxes. But like you said, there's certain things there that are just screaming for an audit. Like I had a $30,000 rounded expense in miscellaneous. You know, they're coming after you.
Just dealt with that today. One of the things I tell people, do not ever estimate your expenses. And if you are estimating your expenses, don't make it obvious. My deduction is $2,500. This deduction is $1,500. The system actually will look for that. They will look for even numbers, 0 zeros. So quick tip, don't do that. And I agree with you. I think the larger or more complex a business is, the higher the chance there is they're going to be audited. So let's see, what other questions?
Let me answer Antoine's while you continue to look. I know there's some more tax resolution questions, but let me get Antoine out of the way. If I close one business account and move money into another account, would that be considered an intercompany transfer? Yes, it's technically a distribution and contribution. So when you close one business and you take that money out, you're taking a distribution from the account. And then when you put that into another account, it's a contribution into that new business. So yeah, it's kind of like a transfer, but it would be more treated as a distribution and contribution. All right, so let's see. Do you see more audits for small businesses versus S Corps, particularly for real estate agents? I think we kind of already addressed.
Yeah, I think we kind of touched base on that. So it's just going to depend. Again, you just want to make sure that whatever deduction you're taking is not outrageous and out of scope for the business you're in. So that will lessen your chance. There's no way to completely eliminate the possibility of being audited. So
All right, Talanka, are we
Yeah.
required to pay taxes prior to filing taxes? Absolutely.
Absolutely.
Go ahead, Tara, you can take that.
It's a misnomer that people can wait until April 15th or even October 15th, which is wrong, to pay your taxes. You have to look at it from the perspective of the government. If you're a W-2 worker, you are actually, before you're even paid, your taxes are taken out. So out of fairness, the minimum the IRS requires is that if you're self-employed, you pay taxes on a quarterly basis. So you are penalized if you don't pay quarterly taxes. However, it's a small penalty, and I think a lot of times people don't pay a lot of attention to it. But yeah, you're actually paying a penalty. It's a late to pay estimated taxes penalty. So yeah, you're supposed to pay them on a quarterly basis. You can go to the IRS website or just Google when are estimated tax payments due, and it'll tell you exactly when they're due. So one of the things that I've found when I'm working with small businesses is one of the problems is they don't have accurate financial systems or a bookkeeping system in order to even be able to determine how much an estimated taxes is supposed to pay. So I tell all the people that I work with, the small businesses, you need to have an accurate financial reporting system utilizing bookkeeping software, or if you feel comfortable doing it manually, doing it that way, so you know how much your company is making on a quarterly basis and then pay taxes based upon that.
Hey, Tyrone, this is Talanka. So the challenge that we have is if you are flipping houses and if you're not going to sell the house until next year, you don't know how much your income is going to be or whether you're going to make a profit or a loss. So how do you address that in that kind of situation?
Well, you're only paying estimated taxes based upon your income for that 3-month period, that quarterly period. So if you haven't made income, you're not going to pay taxes. Simple as that.
Got it. Okay, got it. Thank you.
Mm-hmm.
All right, so LaShawn was asking, in the case of going back 6 years, you need transcripts, you really need anything else? Yes, because the IRS transcripts only record what was reported, but you need to report your overall income. So it's also going back and figuring out what activities you had in those 6 years that may not have necessarily made it into the tax transcripts, and then try to recreate. Like, for example, the transcripts are not going to have your expenses. So, bookkeeping, getting your bookkeeping done of your expenses, because the transcripts probably only have 1099s, so those are things that you look at as well. Let's see, we're getting ready to round up here, 3:58. We'll stay on a couple of more minutes. For a commercial real estate fund outside of SEC regulations, what are the things I must consider from a tax point or no-nos mistakes made? Commercial real estate fund outside of SEC regulation. What are things I must consider from a tax standpoint? I don't think there's any real big thing. For me, when I think commercial real estate, automatically cost segregation comes to mind. For me, that you're able to utilize cost segregation, you're depreciating over 39 years rather than 27.5 years. There's nothing out of the ordinary except the legal. I'm more concerned with the legal stuff. Tyrone, do you have anything on that before we move on?
No, that's pretty much what I would agree with. When you're dealing with commercial real estate, looking at potential tax deductions utilizing cost segregation, I would agree. But no, there's nothing that's different from any other business. Just keep good records. Make sure that you're you're recording your expenses correctly, and that you have backup. I mean, that's one of the things I always I emphasize is for protection. While if you're ever audited, do not strictly depend on bank statements. Always keep all receipts, even if you don't have to keep use the receipts in the process of determining your financials. If you're using bank statements, you still have to have those receipts. So every transaction you have, keep a receipt, put it in a box. And if you ever need to be audited, you say, here, Mr. Auditor, here's my box of receipts. So.
All right, can you share your information? I know we'll be working together soon, but it's okay to share your information for now with Cynthia. She's asking for it.
Yes.
Moses, Israel, Gabby, Ashley, do you guys have anything you want people to know as we are getting ready? Oh, I see Attorney Holman is here. Hi, Michelle. Do you have anything from a legal perspective, a tax attorney that you want to tell everybody about? I didn't notice you were here. I'm so excited.
Oh, thank you. It was wonderful. Presentation was excellent. I'm always interested in receiving and hearing new perspectives and information. I actually learned something. So everyone who's not a tax attorney or or even the speakers, let me just tell you, this presentation was chock full of information. Very worth my time. Loved it.
Okay, so if anybody has any legal questions for Michelle, I actually have one that I'll ask her. If you have any tax related legal questions, I'm sure she'll be more than available as we get ready to round up. A question that came up today was a client. It's her husband, and her son-in-law that are on the deed, but her son-in-law and her daughter have been living in the property. And so really it was their primary residence. Now they're getting ready to sell, and they're going to be hit with this 1099-S, but this was their daughter's primary residence. And so we were trying to figure out whether it made sense to transfer their interest to her prior to closing, or can it be a quitclaim deed? They're closing next week, or should they just having a write up an agreement that says that they're transferring their interest to her so that they're able to get the home sale exclusion? Because I think what happened was that the daughter and son-in-law really were living there for the past 3 years. They're just the ones that were on the deed. What would be your recommendation for that from a tax perspective for the home sale exclusion?
Probably to do the quick claim deed and do the transfer. I know it's all water under the bridge, but I always suggest to parents, never put your children on a deed. Because you come up with situations like this, where the question of the exclusion, that $250,000 if you're single, or $500,000 if it's a husband and wife, becomes problematic. So,
but if they're not able to, are you able to get a quick claim deed that quickly if you only like 1 week away from closing?
I doubt it. But it's worth pursuing just to see what the time frame is, to see if they would be able to do it.
Yeah. Well, thank you.
You got to make the attempt. That you're up against a deadline, and time is of the essence. So you can at least try and say you made the effort. But if it doesn't work, then you just have to play the hand that you're dealt at that point.
Yeah. All right. So, Israel, what is one tip you have for our clients? I'm calling on my people now. Gabby, one tip. Ashley, from your perspective, one tip. Moses, one tip as we round up. Did I put you guys on the
Hey
spot?
everybody. Yeah, I'll go ahead and go.
Okay.
Yeah, but pretty much they have really, everybody has, the presenters has given great tips. It's just important that if you haven't registered a business, make sure you register a business and don't commingle funds. That's if you haven't done that. And if you register the business, make sure that you remember, like Aleemah was saying, to have a business account and actually have everything going through your business. And just like Barry was saying earlier, it's important to say, okay, well, let's get a bookkeeper to go over this instead of the business owner wasting, I'm not really gonna say wasting time, but your time could be more effective instead of you actually taking that time on saying, oh, I could figure this out, when you could just pay somebody and just take time, take more time into working on your business. That's just pretty much the tips I have, which was already said. I just kind of reiterated that again, kind of like a reminder for everybody to keep that in mind, because registering a business and working as a business is like one of the best things you could do in this tax filing situation that we are in. As we all know, small businesses are more recommended and are more looked upon us than personal people, personal taxes. So yeah, that's just my insight on that.
All right, Israel, Ashley, Gabby, anything? And I'll take Tyra's question and we will round up.
Well, I guess to keep in mind that December 31st is the last day of the 2022 tax year. So sometimes that could be, misleading if you're doing taxes, I mean, I'm sure we all know this is basic, but you have to get the year straight, make sure that any deductions that you're looking to take, any investment you're looking to take, to make sure you're getting that in the 2022 tax year. Therefore, when the 2023 tax season comes, then you can claim that on your 2022 tax return.
Great point, Ashley?
I have no additional tips, but everything, all the information was very useful.
All right, thank you, Ashley. Ashley is our business development specialist. If you need to reach out to her, if you're not a client, please feel free to do so. Our last question: for legal and tax purposes, if we wanted to work with independent contractors in another country, whose tax or laws in a legal sense do we follow? This is a little complicated, but that's Attorney Hallman right there.
And you follow the tax laws of where your business is located, which is in the US. Right? You're filing the tax return. But I have to say that if you are, if you're using overseas talent, it depends if you're going through a third party and they're handling all of the legal requirements, but that's an independent contractor, and they have to abide by the laws of their resident country. So that, to me, that's the simple answer. I did want to add one thing, Iberica, because you asked about if there's something that everyone should be mindful of as the year is about to close out. And I would just say this: if you don't want to see me, and if you don't want to have to hire a tax attorney or CPA or auditor or tax resolution specialist to help you out on an audit, please be mindful, if you're a business owner, to keep your personal and your business expenses separate. I can't tell you how many times I've sat across the other side of the table with a rep from a revenue officer, and we're presenting the financial documents, and sometimes in criminal investigations, well, always in criminal investigations, they already have your tax records, they already have your bank records. If there's commingling and I have to explain that, they already look at you side eye, because to them, there's a lack of professionalism and there's a lack of integrity to the numbers because there's significant commingling. So they already, they tend to discount expenses. They tend to discount any deductions that you might want to take just because you've commingled. So don't do that. And there's a lot of ways that you can avoid doing that very simply and easily. And just showing that you understand that there's a difference between your personal life, Netflix subscriptions, trips to Best Buy for, other, household type items, and the money that you're actually spending, through your business and for business related purposes.
All right. So the last question from Dorothy: can you speak to the advantages and benefits of 1031 exchange as it relates to year-end tax planning for people who sell their houses before December 31st? Well, there's very little that you can do, right? Because there's a 45-day window when the clock starts ticking. So if you close on a property, you have 45 days to identify 3 replacement properties and to send that identification list to the qualified intermediary. At closing, you cannot get any cash at table. If you receive any cash from the 1031, you either have to pay taxes on that as boot, or you disqualify the 1031. So if you wanted to utilize a 1031 exchange as a strategy for deferring taxes, first of all, make sure that you're working with your accountant to do the calculation. There have been several people this year that we have saved the headache of not going through a 1031 because it wasn't going to make a difference on their taxes anyway. By the time we finished doing the calculation, it really wasn't worth it, or they were not going to have anything. So just keep that in mind. But if you can do the 1031, you have 45 days from when you close on the property. So if you close on a property today, you have 45 days from today, which is, we're looking at what? December 5th. Am I saying this right? December 23rd to identify 3 replacement properties and send that list to your qualified intermediary, and you have 180 days to close. Please listen, this is very important. If you do a 1031 exchange, do not file your tax return until you have finalized that 1031 exchange, because that 1031 exchange is going to impact your tax year. So let's just use somebody who is closing today on a property. Well, you're closing in 2022. So the 1031 exchange where you're able to defer your gain impacts 2022. So let's say you have till December 23rd to identify your replacement property, and you have till April 30th to close on the property. You have 180 days from November 8th. Am I saying that right? December, January, February, March, April. You have till May 8th to close on the property. You have to file an extension and wait until you're done with the 1031 exchange to come back and finish up your tax return, because it could go both ways. You could go ahead and close on the property, thereby you can now defer the exchange and prepare the Form 8824 to go with your 2022 tax return, or you may not close, it becomes a failed exchange. You now have to pick up those capital gains in your 2022 tax return. So whenever you have a 1031 exchange that is crossing years, you have to file an extension. If you have payments or whatever, remember, extending the time to file does not extend the time to pay. Make your payment and wait until you are done with that 1031 exchange. Okay? Wanted to make sure that you got that. I will go ahead and stop the recording.